Hi everyone. So you're becoming an adult when Excel spreadsheets actually excite you. So I wanted to talk about, I was thinking about this for myself, and then I thought I would share it with everyone else. I was kind of like, well, I should also start to put down a projection plan, which is basically no different than a company that's trying to put together a kind of forecast its earnings over a coming period. Realistically, of course, the goal here is to do it realistically, and there's a series of similar things floating around the web, I'm sure, that are kind of like compounding spreadsheets that are usually used as a sales gimmick. And I didn't want to do that. I actually wanted to create something which I could use as a guide for me on my own. I have time and I want to sharpen the saw. And so basically I would add this on and do this. So I started by creating this spreadsheet, and I want to take you through this, and then I want to get your thoughts on this. You let me know what you think. So I started with first thing I want to do is have some starting capital. The idea is then that I would also potentially add capital to this account. So I've just picked these numbers because I think that they might genuinely reflect the average new traders kind of scenario. And then what I've done is I've put in let's say, call it 4 trades per week as an average, which is probably lower than most people. Most people do this. And I also think it's worthwhile pointing out at this time that we're almost certainly not going to trade every week. My guess would be from about the 15th of December until about the 7th or 8th of January, the market is doing very, very little in most cases, and there's very few opportunities at that point. So that's usually about 3 weeks of the year where you almost certainly won't be doing anything, and this doesn't include your holidays. But I'm averaging it out now. Okay, so bear with me, there's some fuzziness in this. Risk per trade, let's just say, is 1%. And this is what I thought was different. I've added in a win ratio. So your strategy would be about a 60% win ratio. The logic being that you would win 60 out of every 100 trades you'd make money on, is a more realistic approach. I've actually put in a 2-to-1 profit ratio, but it could be 3-to-1. All right, so the strategy might do that. I like the idea here because I thought I'm trying to be really, really conservative and bring it down. So, and then what I've done is I've mapped it out each week. So let me just give you some background behind this as well. I've taken this average monthly addition to the account. I've actually then basically averaged it per week. So in other words, like per week, I've just added in a percentage of that. So in other words, multiply that by 12, divide by 52, and then that would be an average that would be added each week at the end after your results are put in. The other thing that is worth throwing in, the maths on getting, you can see the formulas here are relatively complex, and I probably know a few accountant friends who could go through and double check this, and I'm happy to do that. But the maths on this is quite tricky because what I was trying to do is to say, okay, look, on 60% of the trades you have, you're going to make 2-to-1. And on 40% of those, you're going to lose. But then obviously, and then out of the other remaining amounts, out of those 10 trades, for example, 40% of those trades, you're going to lose a percentage. So it gets really tricky trying to get the formula to jump between percentages and whole numbers when I was doing this. It was very easy to get it to just multiply by 60% and so on. So what I did in the end, which is kind of like a hack, is I basically said, okay, for 60% of your trades, you will get your 2% or your multiplier of that, your 2-to-1 or whatever, on that as your profits out of all of your trades, 60% of it. And then what I've done is said, and it's kind of a brute force thing, I've said, but you only get to keep 60% of that. Basically, I've removed 40% of that for your losing trades, because also you could have your losing trades first, which would reduce your starting point, and then you have to make up. So it's very tricky to get it to be random and realistic. So at the same time, what I did was I basically went very conservative. I said, okay, you'll make 2-to-1 on 60% of your trades, but you only get to keep 60% of that. The other 40% you're going to have to give back to the market as your losses. And actually that rounded down. When I did a very kind of straightforward calculation on that, if I found that on average, my results here are lower than they would be. So for example, if I did it with a single unit and I had 6 trades out of 10 that were 2-to-1, I'd be up 12 on the 2-to-1 times 6, but I'd also be down 4. Okay, then I'd be back down to 8. In an equivalent example, and of course I agree that I could have losing trades up front, I know that, but in an equivalent example here, I actually ended up with 7, so as opposed to 8, which means that this was actually more, it lent more to the negative side. Okay, so that being said, I then put in a formula for this one, which starts off with my base capital. This then starts to build on that and then subsequently adds in the additional capital that's divided over that period. And so then I kind of go to it. I've highlighted the one in orange, which is approximately a year in. So this gives me a starting point from where I am. And so the purpose of the spreadsheet was to give me a more realistic assessment of where I should realistically expect my account to go over time. And here's where it gets interesting. The amount looks huge. So that means that if I start with $5,000 at the beginning of the month and I'm adding in $250 per month over that period, over that period, combined with a 2-to-1 but 60% success rate, 2-to-1 profit ratio, I should be around about $28,630 in, which looks really big. So you're kind of like, that can't be right. That looks really, really big. So what I'm going to do here is take it a different way. I'm going to take a large account. So I'm going to take a fund. So that looks kind of very aggressive, but I'm pretty confident that the maths is close, if not exactly right. I'm relatively happy with where it is. So what I'm going to do here to prove my point, which is where I thought it got really interesting, is I'm going to make this £1 million. 1, 2, 3, 4 million pounds. Okay, so that's $1 million. I'm also not going to add anything to it right now. I'm not going to add any additional capital to this. So if you're a fund manager, you'll be looking closely at this point. I think the average trades per week is probably good, but I'm going to drop it down to 2. So it's hard to get a 60% win rate on 2 trades per week. And of course, some of the trades might close over the next week and so on and so forth. But this gives me an average of about 100 trades per year. It's not so bad. Now, I'm not going to risk 1% per trade. So for the newer traders, on a large account like that, you're simply just not going to risk 1% per trade. It's too aggressive. It's too volatile to do that. So I'm going to risk lower down towards 2.25%. So I'm going to do 0.25%. Which it always forgets the percentage amount, so I have to go and undo that and then just do it again. I don't know why Google Sheets does this. 0.25%, which is rounded up to 3. That's fine. So per trade, I think that that's a fair assessment. I've kept the win ratio and I've kept the profit ratio because I think those are realistic in my experience. And that puts me up at about 120 for that year, which is about a 20%, just over a 20% return on the account, which matches my experience. That matches my experience for discretionary trading, for trend-based discretionary trading. So what that tells me is that the calculations in principle are relatively accurate. That comes back at 120K you'd be up about 20% for the year, which you would through compounding. That's the key thing here. So I'm pretty happy with that, and that's with a 60% win ratio and a profit ratio of 2 to 1. So that should be the case with most of these trades. So anyway, to go back to a more normal individual who's starting here with $1,000, which now your problem is leverage and your starting size as well as a bit of an issue. But if you can add $100 to that account, you can start to see where you could potentially go on this. At that point, I would probably be doing maybe 0.5% per trade, something like that, and that would show me you start to grow up. What's interesting is as we head towards the end of the second year, we'd be closer to kind of $5,500 on that. And actually, if we're doing really well, we should have a 3-to-1 profit ratio. But this is a really good, and I think it's a fairly conservative approach. So again, I'll go back to my original figures, which was $5,000, and then throwing in about $250 a month if I'm able to do that, or even $10,000, for example. And then having a look, I think it's probably, if I'm aggressive about it, probably about 4 trades per week. And I think that puts me back up, interestingly enough, now towards the 14,921. Okay, that's because of half the risk. But I think this is relatively realistic somewhat, and actually that then shows that, and of course at no point here is there any money being taken out of the account. It's literally just being left alone. And so at some point it'd be worthwhile adding in a formula to this that would then start to, once you exceed a certain amount, maybe once you exceed 50 grand or 100 grand, you would start to withdraw $2,000 a month out of that as an example, and then see how that impacts the maths on it. But I thought I'd show this to you. And so again, for the newer traders, the point of this was really to establish a roadmap as to where I want my account to be. And if it's not, it should draw my attention quicker. I should be going, okay, well, why am I not there? What did I do? So the whole idea of this is that it should alert you to how are you missing your goals. Is there a valid reason why you've missed it? You haven't been trading, the trade setups haven't been there, or you've been changing a risk, or you've been doing something differently, or have you done everything accordingly and this kind of guide is off? You might have a bumper week where one week you make 8% because you just kill it, all your trades hit their 3-to-1s, for example. Or maybe what happens is you don't trade another week because there's just no trade setups, which is of course what you should be doing. And so it'll vary, but this gives you a rough guide at least where you should be. Now the idea should be that, yes, in principle, if 60% of your trades, if you understand your strategy and your technical analysis skills are decent, you should, on average, when you take a trade, there should be a 60% chance that you should make some money from it. And so the idea that you might have a down week is possible, but also I would think that the odds are you should very rarely have a down month, because most of your trades should make money as opposed to lose money. So that's the kind of rationale behind it, and also it's there really as a guide each of us can use for ourselves. I'm interested in your thoughts. Please don't hesitate, and also feel free to comment in the comments box below. Thank you.